Hey, welcome to CHIMA Invests. Have you ever found yourself just staring at your bank account, you see a little extra cash sitting there, and you just think to yourself, now what? If the whole world of investing feels like this giant, confusing maze, just filled with jargon and way too many choices, well, you are in exactly the right place. We are about to hand you the map. We're going to break down exactly how to start investing step by step.
This is such a common feeling. You've already done the hard part, right? You've earned the money. You've saved it. But that next step, it just feels like this huge, intimidating leap. And look, leaving that money in a checking or savings account, it feels safe. But really, it's kind of like treading water. And as we're about to see, there's this invisible current that's constantly pulling you backward. Investing? Well, that's how you finally start swimming forward.
So we've broken this whole thing down into 4 really simple sections. First up, we're going to talk about why you even need to invest in the first place and these 2 incredibly powerful forces that are always at play. Then we'll get practical and talk about the how, actually getting your account set up. After that, we'll cover the what. What is your very first super simple investment going to be? And finally, we'll get into the mindset, the thing that really separates successful long-term investors from everyone else. So let's get into it.
Okay, let's start with the big question. Why should we invest at all? Why not just keep our money under the mattress? Well, it really boils down to 2 powerful, totally opposing forces. One of them is silently eating away at your savings every single day. The other one, though, is like a secret weapon that can build some serious wealth over time. Understanding these 2 is absolutely the first, most crucial step. Okay, let's talk about that invisible force I mentioned, inflation. To make it real, let's think about something tangible, something delicious, like a Chipotle burrito. Back in 2019, a burrito cost you about $8.50. Fast forward to today, and that same burrito is around $12. So if you had $50,000 in cash sitting around back then, you could have bought almost 6,000 burritos. I mean, that's a lot of burritos. But today, that exact same $50,000 buys you over 1,700 fewer burritos. That, right there, is inflation in action. Your money's buying power is constantly, quietly shrinking.
So here's the key takeaway. Your cash isn't just sitting still. It's on this slow-moving treadmill that's actually going backward. The U.S. Federal Reserve, the people in charge of the money supply, they actually target 2 to 3% inflation every year. That's their goal. So what does that mean for you? It means if your money isn't earning at least that much, you are literally losing ground every single year. Your goal isn't just to save money, it's to outrun inflation.
But here's the good news. Here's the second force, the one that works for you: compound interest. Einstein supposedly called it the 8th wonder of the world, and for good reason. It's simple, really. Your money makes money, and then that new money starts making its own money. So you invest $1,000, you earn 10%, and now you have $1,100. The next year, you earn 10% on that new total. It's like a snowball rolling down a hill. It starts small, but over time, it becomes this unstoppable, incredibly powerful force for building wealth. So how do we actually get our money growing? How do we put it to work? Well, we look to the stock market. Now, I know that can sound scary, but just look at the numbers. Historically, the overall stock market has averaged an 8 to 10% return per year. This is our #1 tool for not just beating that 2 to 3% inflation, but for really unleashing the power of compounding. Now, it's not going to be 10% every single year. Some years are up, some are down, but over the long haul, this has been the consistent trend. Okay, so we understand the why. We get it. We need to beat inflation, and we need to make compound interest our best friend. Now let's get into the how. What are the actual practical steps you need to take to get started? I promise you, it is so much simpler than you probably think. Okay, when you decide to invest, you basically have 2 main types of accounts to choose from. On one hand, you have a standard brokerage account. The big advantage here is flexibility. You can put money in, you can take it out whenever you want. The downside is you have to pay taxes on your investment gains when you sell. On the other hand, you have retirement accounts, like a 401k through your job or an IRA you open yourself. These have huge tax advantages, but there's a catch. That money is typically locked up until you hit retirement age. So, it's this classic trade-off. Do you want easy access now, or do you want big tax breaks for the future? Now, I want you to forget all those old movie scenes with frantic stockbrokers yelling on the phone. That's not how it works anymore. Today, opening an investment account is honestly as easy as opening a new bank account or setting up an email address. You just go online to platforms like Fidelity, Charles Schwab, or Vanguard, and you can create an account in just a few minutes. They give you direct access to the market right from your computer or your phone. It's really that simple. All right, this is the moment. This is the moment of truth where so many new investors just freeze. Your account is open, the money is transferred in, and then suddenly you're staring at a screen with literally thousands of different options. It is classic decision paralysis. But don't worry, we're going to cut right through all that noise and focus on one simple, powerful place to start. Let me introduce you to your new best friend, the ETF. That stands for Exchange Traded Fund. And the best way to think about an ETF is like a basket. So instead of going to the grocery store and trying to find the single best apple out of thousands, you just buy a pre-made basket that already has hundreds of different kinds of apples in it. In the investing world, this means you can buy one single thing that holds tiny little pieces of hundreds of different companies. Like, for example, the 500 largest companies in the US, which is known as the S&P 500.
The beauty of an ETF, especially for a beginner, is just wow. First, you get instant diversification. Your risk is immediately spread out over hundreds of companies, so if one does poorly, that doesn't sink your whole ship. Second, you're not trying to be a genius and pick the next winning stock. You're just betting on the long-term success of the entire economy. And third, because you're not paying some high-priced fund manager to actively pick stocks for you, the fees are incredibly low. It is simple, it's low cost, and it's a super effective way to get started.
So how do you actually buy one of these things? Well, all you need is its ticker symbol. And I want you to think of ticker symbols just like airport codes for an investment. If you want to fly to New York, you type in JFK. If you want to buy Apple stock, its code is AAPL. And for a really popular ETF that tracks the S&P 500, the ticker is VOO. You just type that code into your brokerage account, decide how much you want to invest, and click Buy. That's it.
And if you need a perfect illustration of why this is so important, just look at this. It's a tale of two investments. Back in the year 2000, Intel was a titan. It was a giant of a company. It seemed like a sure bet. But if you invested in Intel at its peak back then, you still would not have made your money back today. It's crazy. In contrast, if you had simply bought an S&P 500 ETF, which holds the entire market, including Intel, your investment would be worth over 4 times as much today. The goal isn't to find that one winning needle in a haystack. It's just to buy the whole haystack.
All right, we have covered the why, the how, and the what. But this final piece, this might be the most critical of all, and that's the mindset. Because your investment strategy is only as good as your ability to actually stick with it, especially through the market's inevitable ups and downs. This is all about playing the long game.
This quote from the financial blogger Nick Majuli, it just gets right to the heart of the single biggest fear for new investors. What if I invest at the wrong time? What if I buy at the absolute peak right before a crash? We get so paralyzed by that fear of buying at the top that more often than not, we just end up doing nothing at all. But here's the secret. History shows us time and time again that trying to perfectly time the market is a fool's errand. Think about this for a second. On average, the stock market hits a new all-time high about once every 2 weeks. That's 21 times a year. And you know what the most common thing to follow a new all-time high is? Another new all-time high. So if you're just sitting on the sidelines waiting with your cash for some big drop to happen, you are far, far more likely to miss out on the market's steady upward climb than you are to perfectly catch the bottom of a dip. So the practical, real-world way to just keep buying is with a brilliant strategy called dollar cost averaging. It's basically an automatic system for smart investing. It's so simple. First, you commit to investing a set amount of money, say $100. Second, you do it on a regular schedule, like the first of every month, no matter what. So what happens? When the market is down and prices are low, your $100 automatically buys more shares. When the market is up and prices are high, that same $100 just buys fewer shares. The result? You completely remove emotion and guesswork from the equation, and you average out your purchase price over the long run. And if you need one final, powerful reason to just stay invested and not try to jump in and out, this is it. Look at this chart. Over the last 30 years, if you were invested the whole time, you did great. But if you tried to time the market and you just missed the 10 best days, your total returns would have been cut in half, by more than half. If you miss the 20 best days, your gains are down by 73%. And if you miss the 30 best days, your gains are almost completely wiped out. The lesson here is crystal clear. Success in investing comes from time in the market, not timing the market. So what's the end game here? What is all of this hard work and discipline actually working towards? Well, let's look at the potential. Based on historical market averages, if you consistently invest just $500 a month into a simple S&P 500 ETF, you could have over $1 million in 35 years. That isn't some get-rich-quick scheme, and it's not magic. It's just the pure, simple, mathematical power of consistency and compound growth working for you over time. So, there you have it. We've covered the why, the how, the what, and the right mindset to have. All the tools you need are right at your fingertips, and the process has truly never been easier or more accessible. So the only question that's really left is the one right there on the screen, if not now, when? Every single day you wait is another day you miss out on the incredible power of compounding. The best time to start investing was yesterday, but the second best time is right now, today. And that is it, our complete beginner's guide to finally starting your investment journey. I really truly hope this has cleared up some of the confusion and, more importantly, given you the confidence to take that very first most important step. Thanks so much for watching.
If this was helpful for you, please go ahead and subscribe to CHIMA Invests for more straightforward financial guidance just like this. Our whole goal here is to give you the simple, actionable tips you need to build a better financial future. We'll see you in the next one.